Well, for instance, housing has been in a recession. Durable goods has been in a recession. If you look at transports, which are breaking out, but they're cyclically, they've been actually acting like they've been in a recession. So I think a big chunk of the economy has been recession-like, and the skeptics have thinking this would pull the whole economy into recession. But instead, I think the Fed is turning dovish, and it's...
The stock market this year reflects mid-cycle versus negative 125 basis points by year end, which is the Fed cut expectation. So tell us what we're looking at and why it's important to you.
Yeah, what we have here is several segments of the economy: small business loans, mortgages, including adjustable rate and home equity lines of credit, car loans, and credit card rates. And we're showing how much these things will drop when the Fed cuts.
Okay.
This is understating what mortgages will do, because the mortgage spread today is...
It's wide.
It's super wide. It actually historically is 170 basis points to the 10-year.
It's like over 200, I think.
Yeah, so it could drop almost another percentage point.
What, the mortgage rate versus...
For a 30-year fixed today.
30-year fixed versus what?
10.
Fed funds rate?
Or 10-year.
10.
So if the 10-year doesn't move, but the mortgage spread normalizes, we'll have a sub 5%.
In this video, the discussion focuses on the current market dynamics, especially regarding small-cap stocks and the Federal Reserve's policy shift. The conversation begins with the view that the market is showing signs of a significant breakout, with certain stocks reaching multi-year highs, such as Chinese internet stocks and U.S. stock. Despite some skepticism about an extended rally, there is a growing belief that the economy, which has been recession-like in parts, is actually early cycle, signaling positive conditions for future growth. The video then delves into the impact of the Federal Reserve's potential interest rate cuts on the economy, particularly how various sectors like small businesses, mortgages, and consumer credit will benefit. It also highlights how small-cap stocks have been underperforming in recent years, but with the potential for a strong rebound as market conditions improve and multiple factors, such as mergers and biotech growth, come into play. There's also a focus on how AI, electric vehicles, and energy consumption will drive future growth in the market. The final part of the discussion addresses the semiconductor industry, where Nvidia's strong performance contrasts with broader struggles in other sectors like automotive and consumer electronic. The video suggests that while AI-related demand is thriving, other segments of the semiconductor market are facing challenges, leading investors to adopt a cautious, wait-and-see approach as earnings season progresses.
Our stance at Fundstrat is to treat it like a real move. So we did a webinar yesterday for our clients, and Mark Newton really pointed out this is actually a pretty significant breakout, because we've moved to levels that you would expect a much bigger retracement. And he was talking about how many of these stocks then kind of approach multi-year highs. So
Chinese internet stocks, I'm guessing?
Yeah, like KWeb or
Holdings.
FXI. And so...
Ours.
Yes, the U.S. Yeah. And so people who have the $6 trillion cash on the sidelines or low leverage, this now suddenly looks like a really good way to... If I made a measurement gap between like perception of macro versus like logically macro, it's a huge gap, because I think many people think this is an extended rally, an expensive market, and a business cycle that's late cycle. But so much of what you can point to is early cycle. So that's a huge gap that is a positive.
The Russell 2000 is underperforming the S&P 500 by 5.7% annually over the last 5 years, if I'm reading this correctly, which is the worst period of underperformance since the peak of the dot-com bubble.
Correct.
And look what happened after.
Yeah, because unless you can fundamentally make the case that small caps are worse businesses now, because the valuation gap is 8 points a multiple, if there's a chance for the multiple to catch up, including Fed cuts, mergers, regional banks, biotech rallying, all of this would argue that should flip. So small caps should be outperformed. Yeah, and it's actually a dollar multiplier thing that you're talking about. Yeah. On top of that, because I know like Dan Ives has said there's like, I forgot, $3, $5 of non-AI spend that follows AI spending.
Yes.
And if that's infrastructure, or if it's people getting jobs, or if it's software or services or advertising, that does
non-AI spending that happens because of previous AI spending.
That's right.
Yeah.
And then on top of that, as you know, China's been dormant for a long time, and relative outperformance cycle, several hundred basis points a year. And that was a great time for investors because they could find a lot of great stocks that were...
And what is coming out very loud and clear is that the opportunity is much larger. their competitive position is much stronger. And then finally, when I look at the stock, right, we have a stock that is trading less than 1 times earnings growth. And if you were to take an average of the other so-called Max 7, they are trading at 1.9 times their average earnings growth for next year. That is why we think that we are in front of a large opportunity. The company is executing well, and the valuation is very compelling, even at these levels.
Vivek, let me ask you, today's interesting because Nvidia is doing well, but the rest of the semis are actually struggling, and the stocks is lower. What explains that?
Yes, Kelly, I think, this week we had the start of earnings. We had one very tough report from ASML. Then we had a very strong report from TSMC. Next week, we will have a number of other earnings reports from semiconductor companies. And the challenge the industry is facing is that this, one shiny area of AI is doing extremely well, but it is less than 20% of the overall industry. Whereas the rest of the industry, which has to do with industrial and automotive and PC and smartphone demand, that is just not doing as well. So I think it's possible that investors are taking a wait and see attitude before we get into the heart of this earnings season. So I think it's that kind of very normal earnings volatility that we usually see.
That might not be the case this time because they were never reliant on overnight rates. What do you think about that idea?
Small caps.
Yeah. What I think happened is the Fed signaled to the business world in 2022 that there's a hurricane coming.
Yeah.
And so I think businesses got cautious, and the really ones with plentiful cash weathered the storm well. Small caps really got destroyed because of the cost of money.
Isn't that crazy? The government said, or the Fed said, hey, we're putting the brakes on, prepare for a recession. The company said, okay, we'll prepare for a recession. No recession.
Yeah. And as you know, there's obsolescence. So 5% of capital stock depletes. Even tower companies, 5% of towers fall. So there's been deferred expansion. And that's why hiring is stronger, because when you defer capital spending, you actually have more employment. So I think that there's not only deferred CapEx, there's mergers that have been on basically on hold.
IPOs too.
Yeah, capital markets. And at a time when there's probably a lot of things that now could be done, and now with some confidence and boards can improve. So I think it's going to be very expansionary, but obviously biggest beneficiary should be small caps because they got hit. Actually, if you only did profitable, it's like 12 point something.
Okay.
And in the S&P, it's close to 18 times now.
Yeah.
So you could just have an 80% move in the Russell just by the multiple expanding.
Okay.
But earnings are growing faster, and typically they trade at a premium. So you have many ways to win on the Russell. There was some sort of storm and it shut down businesses. So he said claims were going to just go a little wacky. And so I think some of this was seasonality, not isolating. And do you remember the labor reports were really funky around then too?
Yes.
So I'm sorry, I do remember that spike. And I do remember Sam even walking back her rule when it was triggered.
Credit to her.
Credit to her. Yeah. She said yes.
What are we looking at here? You have a chart of a lot of the components of CPI back to pre-pandemic levels?
Yes, that's right. And what that red line says that before the pandemic, historically 50% of CPI components are below their long-term average.
Oh, wow.
So that's a sign of inflation's under control. We crossed 50%, as you can see, in late 2023. And that number now has crept to 55%. So by this measure, world and data center is US. And so that means power has to be built around here, or maybe in the Middle East. I mean, who knows? But both kind of move in lockstep.
So you like that theme? You believe in that theme?
We actually had our summer interns work on that theme because there are three sources of sort of extraordinary power consumption. One is electric vehicles. The second is AI and data centers and the intensity of energy. And third is crypto. Okay. Is digital money. Okay. So all three are going to be sort of tailwinds for I don't actually have the numbers off to my head.
Okay. But so the conclusion of that research was this theme has legs.
Yeah, so power production. And it could be even things like ceramics and other ways to optimize energy production or cooling, it's energy production and cooling, but all related to efficiency of power.
If Mark Newton were sitting here, what would he say about the internals and the technicals? Let's do this percentage of members above the 200 day.
Yeah, or it's a test because if it's strong, it strengthens from there.
Okay. All right. Is this something that's important to you, the behavior of stocks inside of the indices? When you're like
the internals?
The internals in general?
I think it's important. I think people can sometimes overinterpret internals. Like for a long time, people were criticizing the market because it was led by 7 stocks, but that's actually wasn't a sign of weakness. It was just, I think the dynamic would be different if people were fully invested and the market's narrow, because then you realize you have no more oxygen. But we have so much cash on the sidelines. Margin debt is still below where it was in 2021. So there's firepower, and now the Fed's dovish,
Right.
and China's turning. So like, as you're saying, Michael, it's like a lot.
The current market environment presents a significant gap between macroeconomic perceptions and the reality of early cycle conditions. While many remain cautious, expecting a recession, parts of the economy, including housing and durable goods, have already experienced a recession-like state. Small-cap stocks, having been hit hardest by tighter monetary policy, are now well-positioned to benefit from improving conditions, especially as the Fed signals a more dovish stance. As valuations narrow, small caps are expected to outperform, offering a potential for growth driven by multiple expansion and positive earnings momentum. Additionally, sectors like AI, electric vehicles, and digital currencies are driving energy consumption, which may fuel further growth. With global trends indicating increasing demand for energy efficiency, this could have long-term positive implications for the economy. The current valuation gap between large-cap and small-cap stocks offers an opportunity for significant returns, especially as the overall market stabilizes. Are we seeing a recovery in small caps, and could the expected Fed cuts be the catalyst for this? How do the current macroeconomic trends influence stock market volatility and sector performance?